government has given a lot of money and credit to people. They've put it out. Well, no surprise, that's leading to a lot of inflation. Okay, inflation takes buying power away from people. And it also means that then there's going to be higher interest rates, and that's going to squeeze people. Yeah, so I think there are three big forces to keep your eye on. And when you see them in their cycle, then it's clear. First, are you earning more than you are spending? Well, you can have both. I want them to look at it as the country, but the country is nothing more than the aggregate of the people. And so when you look at those three forces, I want to make sure that they're clear and you could align them up and you could see where you are. Is the country earning more than it's spending and building savings, or is it spending more than it is earning and creating debt? Because one man's debts are another man's assets. And when somebody is holding those assets and they're producing a lot more of that money in debt, they go down in value. Money goes down in value as they produce it to produce that buying power. And then that gets people bad returns, it produces a higher amount of inflation, and it produces bad returns for holding debt or bond. So in other words, cash or bonds. And then people get out of cash and bonds, and that produces rising interest rates while there's rising inflation, and that produces stagflation. So I want them to get the mechanics of that, because that's happening now. You could see it. This is not controversial. We are producing a lot of debt. We're spending a lot more than we're earning. And as a result, they're printing a lot of money, and the printing of a lot of money creates a lot of inflation. And with that inflation, then nobody wants to, cash is trash. You don't want to hold cash, and you get out of that, and that causes rates to rise. And that's one of those three factors. So you can see it happening, and you could also see the cycle of it as shown in the book. The second force that is dealing with is the internal conflict force, how you are with each other. Are you operating cohesively, common mission, and moving in the right direction, the system working? Or are you at each other's throats? Is the system threatened? Because history has shown when the causes that people are behind are more important to them than the system is in jeopardy. And that is a risky situation. It's a risky situation because it produces disorder, and it can produce a form of civil war. And at those times, when you have that, you see greater and greater polarity. In politics, it shows up at greater and greater populism of the left and populism of the right. And populists want to fight for their side. They're not moderates. Moderates want to work together to try to find a compromise that's best for the whole. Populists appeal to their crowd by saying, I am fighting for you. And they will fight each other. And that fight can be at the threat of the system. So in history, for example, we saw 4 democracies in the 1930s choose to become dictatorships as one side fights to the other because they become so disorderly. And we have a system right now that you could see that it is possible in elections that neither side might accept losing. And so the system becomes in jeopardy, and you see that the moderates leave the system. You can't be moderate. You have to pick a side and fight. And so you see this in the French Revolution. There were moderates in the early part of it, that recognizing that there were problems and wanting to work together. The moderates got guillotined. The polarity began. The same was true in the Russian Revolution. The same was true in the Chinese Revolution, the Cuban Revolution, and so on. Those polarity gets greater and greater as there's a greater intensity to fight. And that is the internal piece. And so you could see where we are in that internal piece right now. I mean, there is a great polarity, and you're seeing that lead to changes in where people live. They're moving to different areas, not just because of tax reasons, but because of differences in values. And so that kind of, you can see it today happening, these things, but you also can see the arc of them in the book because it measures statistics. It shows these things happening. So when you have a financial problems and you have this kind of polarity and you have a bad time, you have a lot of fighting internally. So imagine where we are in the economic cycle. We're in the part of the economic cycle where they have given, the government has given a lot of money and credit to people. They've put it out. Well, no surprise, that's leading to a lot of inflation, okay? Inflation takes buying power away from people. And it also means that then there's going to be higher interest rates, and that's going to squeeze people. And so that makes that wealth gap and that wealth issue more difficult. So that's where we are now. And that also is risky because it threatens the value of the dollar. Because right now, debt is dollars. Any currency, the way you hold it is you hold it in the form of debt. You don't hold it just in paper. And because there's a rising inflation, and because there's a lot of printing of money, and because there's also a greater fear on a number of countries that they too could be sanctioned. And so there is that dynamic that's going on. The capital wars are the ones that accelerate immediately before the military wars. Usually the coffers are empty, they're printing a lot of money, and then they're trying to use economics as a weapon. So we're in that part of the cycle. Now, in terms of how this will transpire, well, first thing is you realize that holding cash and dead assets is a bad thing. So a lot of money is in cash because people think that cash is the safest investment. But they are measuring that in the amount of money that they get, nominal returns, and they say it doesn't wiggle much. But think about it. It's lost, as of the most recent statistics, 8.5% over the last, inflation is 8.5%, and they receive virtually no interest rate in cash. And so there was an 8.5% loss of buying power as a result of inflation. And so psychology should change and is in the process of changing to realize that you have to think in terms of buying power, not the number of dollars you have. And you have to think how much is your buying power. And so the worst thing is to be in cash. Like I say, cash is trash, and to be into and to be out of the bonds. The next thing is to have a diversified portfolio of assets. The diversification means some assets that are inflation hedge prone. For example, you're better off to own an inflation index bond. I think the punchline is, if you take a look at it, it's simple. It's like a regular bond, except its payments are linked to the inflation, so they compensate you for inflation. Now, flooding into any one thing is an issue, but moving from the nominal bonds, in which the government just says, I'll give you this amount of money, and it has the unbelievable and unlimited ability to print the money it gives you, it would favor inflation index bonds. And it could be other assets. Some people would say something in terms of cryptocurrencies, or it might be those other assets. I think that too much people pay too much attention to one at the extreme of the other. That either somebody's all crypto, or they're all gold, or they're all something. And I believe that that's a challenge. I think that crypto, like gold, is not a productivity earning asset, and it can be controlled by governments in lots of ways. It's been outlawed in a number of places, and it also can be monitored. The privacy element is not secure from governments doing monitoring, and so and the size of crypto is about the size of Microsoft. It's all crypto combined. And so to be overly concentrated in it, in my opinion, is a mistake. But to have some of it is a good thing. So the question is always what amount of it. So that's I have a little bit about it. I'd probably shock you about how little I have. You would shock me about how much you have. But having some of it. For example, we just had the shooting in New York City on the subway, and New York City's becoming more dangerous. Chicago's becoming more dangerous. San Francisco's becoming more dangerous. You're seeing people leave some places for other places. You're seeing them leave, I don't know, to Texas is Austin, or to Florida, and so on. So there are differences in within the United States, and because when people do leave, and they do that, those who leave are higher income and higher taxpayers, and as a result, there's more of a hollowing out that takes place in that, which creates an economic problem as well as a lifestyle problem. So I think you're going to see greater differentiation in places, which affects where you want to be and where people who can afford to be there want to be, and also affects what their economies and markets are like. And then the United States. And the third element is, are they financially strong? In other words, income more than expenses and good balance sheet. Are they civil with each other? So they're working together rather than hurting each other. And number three is, are they in a position where they're likely to be in a war, or are they likely to be out of a war? You don't want to be in a war. So, and those places, investing wise, history has shown, do worse, because they have to spend more money. There's more problems, more pain that's being exchanged. Neutral countries in wars do very well, as it turns out. So elements of diversification. So it's a long-winded answer to your question, but I would not want to be in debt or cash and those instruments. I would want to diversify well with a bias toward inflation-protected assets. And I would want to diversify between locations, countries, in terms of the investment based on the criteria I've just mentioned.